move into a macro. Now, a macro is me showing you how it's been codified, coded, scripted to run for inefficiency or liquidity. That's what that 20-minute interval every single hour, it does this. Now, if you understand that that is where price is going to seek to jump to reach for, to draw towards, move in the direction of an obvious inefficiency above or below the market, or an obvious relative equal high or low, or a singular high or low, like a London session high or a London session low. Sometimes they're not always a relative equal low or relative equal high. In London session, that one we treat a little bit differently because it can be a singular high, not relative equal highs. So a SMT divergence will form usually just before the delivery from a macro. So in other words, you're going to get that price run high. Like imagine for a moment, the market's been rallying, and it goes up, creates a short-term high, and it trades off. And we'll say we're watching the NQ, Nasdaq, and then some period of time, and I'll leave that up to the time frame you're looking at because this forms on every time frame. And then it rallies up and makes a slightly higher high than the previous high in Nasdaq as we approach the beginning of a macro time. It can happen inside of a macro time. If it does, then it's super fucking star. It's gonna rock. It's gonna be a rock star performance because you got best of both worlds right there at the same time. But usually SMT will form just before a macro, and that stop hunt is the damage that frees the market to deliver under the basis of that macro time. Because remember, the macro is where all traffic is removed. That's the bias is short, but it isn't always open, go straight down, close. How we trade initially after the opening, because in a perfect world, what we want to see is when we're bearish, it opens, rallies up, and takes out the liquidity above 7 to 9 o'clock in the morning, or London high, or Asia's high. And we use the economic calendar to bridge that. Which one do I really want to focus on? But we always, every single day, use the liquidity that's formed just after 7 o'clock Eastern time, prior to the 9:30 opening bell. Those pools of liquidity cannot be hidden from you. And when it's a clear, obvious relative equal high or relative equal low, and it would match how the daily candlestick should form for the purposes of Power 3. In other words, you're bullish, your bias is bullish. You think the weekly chart's going to keep working towards a level higher. Okay, wonderful. That means you're going to be looking for easy bread and butter idea is at 7 o'clock in the morning, go to 9:30. At 9:30, in that last 90 minutes, where is the relative equal lows? If there is no relative equal lows, just find the lowest low, if it's a singular low. That's where you're going to expect the price to drop down in a perfect world. But because we have to watch and see what the opening range can do for the first 30 minutes, unless it just does exactly what we're expecting right out the gate, which is a Judas swing, and when we're bullish, it drops down and goes for the liquidity. Then you know what you're waiting for. Go down there and get it, soup it, use the first resistance fair value gap that you come to after it runs the liquidity. Okay, it's a little variant on the gauntlet. It doesn't have to have a breaker there. Okay, so running it, I have to slip that in there, and people that didn't stay on, they didn't hear that. But the raid after going down to hit that sell side, even if it's going to go lower, the chances of you getting 50% of that drop down, that many times can be a trade. It can yield you 20 handles. It could yield you, and in today's volatility, it could be as much as 50 to 100 fucking handles. You know, it's relative to what you're seeing in terms of volatility at the time when you're looking at the market versus, well, guessing what it's going to do. Yeah, there's a process of you determining what liquidity it should reach for. Perfect world, it drops down for liquidity, makes the low of the day, and then all day long, the rest of the day, it just keeps going higher. That's a perfect classic buy day. They happen about 4 to 6 times a year. a month. Every other day might get like you're bullish, your bias is bullish. The weekly chart you're calling for a specific premium PD array, and then the market rallies first. Well, that don't make any fucking sense. Like, you want to see it drop down. What do? You wait. And then if it's left relative equal lows during the opening range, it's going to come back down for the silver bullet to get that. Then run higher going into the lunch. And then whatever short-term high that's in the middle of that run, it'll bump down into that during the 2-hour lunch period, hit that liquidity, and then expand for the rest of the day, giving you the classic up close when you're bullish. There's only a few scenarios that's going to pan out. There isn't dozens, okay? If the market's going to close high or close low, there's only 3 scenarios that's there. 3, that's it. Experience is going to dictate how those 3 scenarios look and narrate that price being delivered for the daily candle. That's it. That's how it is. The only caveat to that is it's going to start off as it should, and then it goes into seek and destroy. And that's always the wild card. Well, guess when that usually happens? The week of PMI. It's the week of non-farm payroll, FOMC rate announcement, CPI number. That's it. Nothing else. Nothing else invites the seek and destroy. So you may not know if it's going to rain today, but you can identify when the clouds start forming, okay, where are we at on the economic calendar? This could become seek and destroy. So if you made money and things start looking stupid, turn your charts off. Isn't that easy? That's easy. Everything has a process. Everything has a place and a time for it. And you have these rules and these processes and protocols. It removes all of that fear of missing out. It removes all that greed. I have to have a winning trade right now. It removes the necessity of you being right every single time. It gives you the strength to know that what you're using is sound logic. It is not to do away with, well, throwing the baby out with the bathwater. That's usually what happens. And the long and short of it is until you place yourself in front of the charts and you submit yourself to it, you won't see these things. You won't benefit from it. But they inspire me. I don't look at them as, oh, they're hurting my feelings. Like, I love it. Because I can come out here and remind you this, that, and the other thing. And you can't cancel it. You can't argue against it. It's not like I'm not telling you before it happens. Look at the week. Look how we traded inside that range of non-farm payroll Friday high. We were aiming initially for Thursday's high of last week. And we used that daily fair value gap that was bullish. I shaded in yellow. I said no close below keeps it valid for it to send price higher. And we spent most of the week doing what? Reaching up. Now, a apt pupil, someone that's really interested in wanting to learn, they'll go down into the 15-second chart and look for every relative equal low when it formed and when it ran through that and then sent price higher. And that is your everyday model. That's your everyday deliverer. Every time you get in front of the charts, you're looking for that. And that forms every 60 minutes. You got to know what it's reaching for, though. You derive that from a weekly and a daily chart minimum. Nothing less than a daily chart. But primarily, you want to use a weekly chart. What is it reaching for? And every relative equal low on a 15-second chart, once it's rated, if you take the first presented fair value gap, after that, you have a high frequency trading algorithm right there. For a short-term high or relative equal high or inefficiency above it, that's your first partial. And then you hold it and see if it can start delivering to that higher time frame target. And then if it does, once you get up to 11 o'clock, if you can afford to take a partial, do so. Because you might have the lunch hour, which is really 2 hours long. It could retrace and go even beyond where you got in at and shoot for a London low, upset the people that are in there long. That's more likely to occur if you're in the discount area of that primary range that you're expecting to see delivered on a daily or weekly basis. In other words, that draw liquidity that you're aiming for bias purposes. When you're in the first half of that price run that would materialize, there's going to be stop hunts like that will occur. So you have to trade differently a little bit there. But when we get to a premium side of that price run, you won't see these big drop down. They won't need to come down there because they want to get closer to that exit strategy of getting out at that pool of liquidity or that inefficiency that's a premium.